Hey everyone! Today, we're diving into one of the most debated topics in the world of investing: dividend growth versus high yield. Which will make you richer? If you're looking to build wealth through dividends, you've probably wondered whether it's better to chase stocks with massive dividend yields or focus on companies that steadily grow their payouts over time. Both strategies sound appealing, but they come with different risks, rewards, and long-term outcomes. In this video, we're breaking it all down, covering what dividend growth and high-yield investing are, their pros and cons, real-world examples, and which strategy might be best for you. Whether you're a beginner or a seasoned investor, stick around because we're about to unpack everything you need to know to make smarter investment decisions. Don't forget to like, subscribe, and hit that notification bell so you never miss a video. Welcome back to the Trade Savvy Academy. What are dividend growth and high-yield investing? Let's start with the basics. Dividend growth investing focuses on companies that consistently increase their dividend payouts over time. These are typically established, financially stable companies, like Coca-Cola or Johnson & Johnson, that raise their dividends annually, even if their starting yield is modest, say 2 to 3%. The magic happens as those dividends compound, and over decades, your income stream grows significantly. On the other hand, high-yield investing targets stocks with above-average dividend yields, often 6% or higher. Think real estate investment trusts, REITs like Realty Income, or energy companies like ExxonMobil during certain market cycles. High-yield stocks provide immediate cash flow, which is great for income-focused investors like retirees. But here's the catch: high yields can sometimes signal risk, like a struggling company or an unsustainable payout. Dividend growth prioritizes long-term stability and growth, while high yield focuses on maximizing current income. Both can build wealth, but they cater to different goals and risk tolerances. Let's dive deeper into how each strategy works and what makes them tick. The power of dividend growth investing. Dividend growth investing is like planting a tree today that grows bigger and bears more fruit every year. The core idea is to invest in companies with a proven track record of increasing dividends, often called dividend aristocrats, companies that have raised dividends for at least 25 consecutive years. Take Procter & Gamble, for example. In 2000, its dividend was about 35 cents per share, with a yield of around 2%. By 2025, that dividend has grown to over $1 per share, and if you'd reinvested those dividends, your effective yield on your original investment would be closer to 10% today. That's the power of compounding. These companies are often industry leaders with strong balance sheets, like Microsoft or PepsiCo, which means they're built to weather economic storms. The trade-off: lower starting yields mean less immediate income, so it requires patience, sometimes decades, to see massive returns. This strategy shines for younger investors or those with a long-term horizon, as it balances income growth with capital appreciation. Plus, dividend growth stocks tend to outperform the broader market over time with lower volatility. According to a 2023 Hartford Funds study, dividend aristocrats averaged 10.2% annual returns from 1990 to 2022, compared to 7.6% for the S&P 500. Now, let's talk high-yield investing, the strategy that promises big payouts right out of the gate. High-yield stocks, like AT&T or certain REITs, such as Annaly Capital Management, often offer yields of 6%, 8%, or even higher. For income-focused investors, this is like a paycheck you can rely on monthly or quarterly. Imagine owning 1,000 shares of a stock yielding 8% at $20 per share. That's $1,600 a year in dividends. High yields are especially attractive for retirees or anyone needing cash flow now, not in 20 years. Sectors like utilities, REITs, and energy often dominate this space because their business models generate steady cash. But here's the rub: high yields can be a red flag. A stock yielding 10% might be that high because its share price has tanked due to financial trouble, like AT&T during its debt-heavy years. If a company can't sustain its dividend, it might get cut, crushing your income and share value. Look at General Electric in 2018. Its 12% yield looked juicy until it slashed its dividend to a penny. High-yield investing can work, but it demands careful research to avoid yield traps. You need to check payout ratios, debt levels, and the company's ability to maintain that dividend. Comparing returns, growth versus yield. So, which strategy makes you richer? Let's crunch some numbers. Dividend growth stocks often start with lower yields, but grow over time, boosting both your income and stock price. High-yield stocks deliver more upfront, but may lag in capital appreciation. Let's use two hypothetical investments to illustrate. Suppose you invest $10,000 in a dividend growth stock like Coca-Cola in 2005, with a 2.5% yield and 5% annual dividend growth. By 2025, assuming reinvested dividends and modest stock price growth, your investment could be worth $25,000, with an effective yield on your original cost of 8 to 10%. Now, take a high-yield stock like a Riot yielding 8% in 2005. If the dividend stays flat and the stock price grows minimally, your $10,000 might grow to $18,000, with consistent income but less total return. Data backs this up. A 2020 study by S&P Global found dividend growers outperformed high-yield stocks by 2 to 3% annually over 30 years, largely due to compounding and stock price appreciation. However, high-yield stocks can shine in flat or bear markets, providing steady income when growth slows. The key difference? Dividend growth often wins for total return, income plus capital gains, while high-yield excels for immediate cash flow. Your choice depends on whether you prioritize wealth accumulation or current income. Younger investors might lean toward growth, while retirees might prefer high yield for living expenses. Let's talk risks and downsides. No investment is perfect, and both strategies have risks. For dividend growth, the biggest hurdle is time. If you need income now, waiting 15 to 20 years for dividends to compound might not cut it. Also, even blue-chip companies can stumble. Look at 3M, a dividend aristocrat that cut its dividend in 2024 after decades of increases due to legal liabilities. Economic downturns can also slow dividend growth, impacting your returns. High-yield investing, meanwhile, carries higher risks of dividend cuts or company instability. A high payout ratio, say over 80% of earnings, signals a dividend might not be sustainable. For example, Kinder Morgan, an energy company, offered a juicy yield in 2015, but slashed its dividend by 75% in 2016 when oil prices tanked. High-yield stocks are also more sensitive to interest rate hikes, as seen in 2022 when REITs struggled as rates rose. Both strategies face market risk, but high-yield stocks are often more volatile due to weaker fundamentals. To mitigate risks, diversify across sectors and check financial metrics like debt-to-equity ratios and free cash flow. Dividend growth offers more stability, but high yield can work if you pick strong companies and monitor them closely. Let's move on to real-world examples. Let's look at two real companies to bring this to life. For dividend growth, consider Johnson & Johnson, a healthcare giant and dividend aristocrat. In 2000, its dividend was 70 cents per share, yielding about 2%. By 2025, it's over $4.80 per share, a 6% annual growth rate. If you'd invested $10,000 in 2000 and reinvested dividends, you'd have over $40,000 today, with a yield on cost of nearly 12%. The stock price has also more than tripled, showcasing the power of growth plus appreciation. Now, for high yield, let's take Realty Income, a RAT known as the monthly dividend company. In 2000, it yielded around 7%. A $10,000 investment would generate about $700 annually then and still does today, as its dividend growth is slower, around 3% annually. Your total return, including stock price gains, might be $25,000 by 2025. Not bad, but less than Johnson & Johnson. Realty Income's strength is consistent monthly income, ideal for retirees, but its slower growth limits long-term wealth. These examples show dividend growth often outpaces high yield for total return, but high yield delivers reliable cash flow for immediate needs. Ready to start? Here are some tips. For dividend growth, focus on companies with payout ratios below 60%, strong cash flow, and a history of 10+ years of dividend increases. Use ETFs like the Vanguard Dividend Appreciation ETF, VIG, for instant diversification. For high yield, stick to sectors like REITs or utilities, but check payout sustainability. Look for payout ratios under 80% and low debt levels. Use tools like Seeking Alpha or Yahoo Finance to screen for quality stocks. Reinvesting dividends, especially in growth stocks, turbocharges returns, so consider a DRIP, dividend reinvestment plan. Diversify across 10 to 20 stocks to reduce risk, and monitor your holdings quarterly for red flags like rising debt or declining earnings. Finally, stay patient. Both strategies require discipline to see results. Whether you choose growth, high yield, or both, consistency is key. So, dividend growth versus high yield, which will make you richer? Dividend growth often wins for long-term wealth due to compounding and capital appreciation, but high yield shines for immediate income needs. Your choice depends on your goals, timeline, and risk tolerance. A smart investor might even blend both for the best of both worlds. What do you think? Are you team dividend growth or team high yield? Drop your thoughts in the comments below and let me know if you want a follow-up video on building a dividend portfolio. If you found this helpful, give it a thumbs up, subscribe, and hit that bell for more investing tips. Check out the links in the description for tools to research dividend stocks and join our community for exclusive content. Thanks for watching, and I'll see you in the next one. Keep building that wealth.